Welcome back, guys. So in this video, I'm going to be explaining a very simple entry model called the change in state of delivery, the CSD for short. Now, this entry model is very simple and it has clear rules. So like the name change in state of delivery, what it means is price being delivered to the buy side and then change to be delivered to the sell side. So here is the buy side and here's the sell side. So it's just a change in state of delivery. So if you want to enter a trade, as price is delivering to the sell side, let's take, for example, you want to buy. You want to see something in price to tell you that price wants to change from the sell side to the buy side. So the change in state of delivery. So this helps you know when price wants to change direction. And as smart money traders, we always buy when market is selling and sell when market is buying. I hope we understand that. It's not like when market is selling, you want to be buying, you lose. No, what I mean is as price is coming lower, it's giving us a cheaper price. So we want to buy as price is coming lower with the anticipation that price will rally from this point. And if price is rallying higher, we don't want to start seeing price run lower first before we sell. No, as price is rallying higher, we know that something will happen here to tell us that price wants to change direction. So as price is rallying, that's when we want to be selling. So it's giving us a premium. Price is expensive as it's going higher. I hope that's clear. All right, so let's go straight to the entry model. First of all, I just want to give a basic understanding of this entry model. It's just basically the ICT order block. Now you can see price was being delivered to the buy side and then created what? A bullish up close candle, as you can see here, this green candle, and then rallied lower. So here is a change in state of delivery. Price was delivered to the buy side. Now we are seeing price delivered to the sell side. Now, what do we see here? Now we can see that there is a close below the open of this candle. So let me just go slowly for the new traders. Now, this candle here, this is the high, this is the low, this is the open, and here is the close. That's for a bullish candle. For a bearish candle, here would be the high, the low, here will be the open, and this will be the close. I hope we get that. So now, we can see that price created what? A bullish up close candle after taking this high. So if we are selling, for instance, let's say we want to sell. As soon as price takes this high, when a bullish candle is formed, that is our order block, we want to see a closure below the open of that candle. So here's the open, if you remember. Now you can see that this candle closed below the open of this bullish candle. This confirms our change in state of delivery. It's just very simple. I'll use this candle here. Now you can see that this consecutively down close candle here, I'll draw it out. Here, price closed above the open of this consecutively down close candle. And this candle here confirms our change in state of delivery. All we are looking for is the creation of our order block and then subsequently a closure below the open for a bullish order block or a closure above the open of a bearish order block. So this confirms the change in state of delivery, telling you that price has changed delivery from sell side to buy side, and then here from buy side to sell side. This helps confirms change in state of delivery. All right, so how do we use this for entries? All right, let's get into that. Now, a change in the state of delivery in price is often an early clue that a market shift or a break of structure may be coming. It's used to anticipate reversals or the start of a new leg in price. Think of it as the market changing gear. When price delivery changes, smart money may be preparing to run liquidity in the opposite direction. Now, this was explained in the previous slide. All right, so now what are the rules? Now, I'll run through the rules before we go to the charts, and then I will explain it proper. Now, I always like to break down my trading rules into conditions, entry, stop, and take profit. I learned this from a YouTube channel called The Trading Channel. So here we'll be dealing with the buy trade rules, and the same thing applies to the sell trade rules. So you just need to take the reverse of the buy trade rules for the sell trade rules. So for the conditions atomized here, we want to see a down close candle at a point of interest. So let's say you want to be buying at an additional level, a higher time frame order block, or a breaker block, or a fair value gap, or price taking out what? Sell side liquidity. So when you go down to a smaller time frame, let's say 5-minute time frame, you want to identify the down close candle. So you identify a down close candle here. So now the next thing you want to see is that the order block must be confirmed by a candle closing above the open price of the down close candle. So it just means that the open at this point, we want to see another candle close above it. Not the wick of this candle, but the open price of this down close candle. All right. The next thing is the order block or its swing must form the lowest low in the structure. So we want to see the order block or this swing here form the low. Now I'll explain this in the chart when we move forward. So we want to make sure that it forms the lowest low. We don't want to see something like this, price forming something like this, and then we want to be using a close above. No, we want to see it form the lowest low. Now remember, this is a 5-minute time frame. These are small time frame for entry. So that's all for the condition. So where do we enter? We'll be entering at the open price of the order block. So we wait for price to return back to the open price. As soon as price closes above it, wait for price to return. And then we want to use, now it depends on the time frame you would like to use, but I use the 3 minutes and 5 minutes. So how do I choose which to use? I select the one offering the best risk to reward ratio. So let's say we have on the 3-minute time frame, the open price is at this point. But on the, and then there's the low is here. And then the 5-minute time frame, we have the open price here, and then we have the stop here. So if this is my target here, let's say we have this as a target. Imagine this doesn't offer the best RR, risk reward, but this does. So I'll use the 5-minute time frame. So if you don't understand this, don't worry, I'm going to explain the chart. Then now, where do we place our stop? Very simple. We just place the stop at the low. So place stop below the swing low containing the other block. So this is the other swing low containing the other block. So I'll place my stop here. And then we want to use a maximum stop of 30 pips. So you could decide how much you could use, but this is what I use. Because most times you'll discover that some of the trades you would see, the entry price will be too far from your stop loss. And your target will just be somewhere here. So it's not worth it to take this kind of trade. And we know in forex market, price moves of an average of 50 to 100 pips per day. So as a day trader, you wouldn't want to be risking more than 30 pips. And then the take profit is 3R. I actually use 3R because of my strategy. So I just want you to make sure you backtest your strategy and note how much you could risk to gain. So using this entry model with a strategy I'm also going to give you, you can actually use a 3RR. All right, so let's go to the chart. All right, so here's the British yen, the daily time frame. So we can see how price changed the state of delivery. It was delivered on the sell side here and then delivered on the buy side here. Okay, so now we all know how price moves from external liquidity to internal liquidity. Here is external liquidity. Price created a range from this high to this low. Now we can see how price took out the sell side liquidity. This is external liquidity. So we expect that as price takes this external liquidity, it should move into the internal liquidity. We don't have this information yet, although we can see how price takes out this low and then takes out this high. So we don't have information yet. So as soon as we see it on a higher time frame, we can move down to a smaller time frame. We're going to the 1 hour time frame. All right. So you can see there's a sell side liquidity that was taken. Now we can see this consecutively down close candles that were formed here. You can see how it was formed. As soon as price closed above the open, it confirmed our change in state of delivery. And as you can see, price found support and then rallied. So here's a trade. Now you can as well go down to a smaller time frame and look for the same thing to take a trade. Let's say 5-minute time frame or a 3-minute time frame. But let's go on. Assuming you're a swing trader, we can see consecutively down close candles were formed. And this candle here validated change in state of delivery because it closed above the open. Now we are using the open, not the wicks. Remember? The open and not the wick. So you can see how price closed above the open. Price returned here, you'll be buying. Came a second time, you'll be buying. Now we can see another here. I did not highlight. Price closed above the open. You can see how, let me just take this here. You can see how price found support and rallied. So you can go down to smaller. You can see this is the New York Fusion. That's the next day and rallied. So you can see this down close candle price closed above the open came back, found support, and then rallied. Now we can see how price actually took out this low here, and then took out this low here, finding support in this bullish order block. So if you would have used this, let's just draw it out. I don't know if price, I think price closed above this. So you can see how price closed above this consecutive down close candles open, and then came back, found support, and then rallied. We can take this trade. This is short-term trade before price taking out this low. So you could remember I said this is where our stops will be, this is where our entry will be. But if you'd have taken this trade here and left it to run from this point to this point, let's see how much. Somewhere around, so we can see this 3 hours. So this is what we did now, 3 hours. So for how many days? So we entered day 1, 2, 3. So for 3 days, a good swing trade. Now this is applicable to whatever time frame. Okay, so we can see here again price forming consecutively down close candles, and then this kind of validated chain state of delivery. So you can see how price returned briefly and then rallied. So this also, you can see price here finding support. So price came down lower and then rallied. So the major thing is we want to be entering at the open of the candles. All right, so let's look at another example. Okay, we can see price did not return. So if it is a single candle, you just draw out the open. But if it is consecutively down close candle, now when I say consecutively down close candle, I mean all the candles are the same. So from here to here, this is not consecutively down close candle. Why? Because we have an up close candle in between. So this bearish candle starts from here. All right, hope that's clear. So you can see here, from this candle to this candle, they are all the same. They are all down close candle. There's no up close candle. That's what makes it consecutively down close candle. So you want to start from the candle where they are all the same. All right. So now you can look at this point here. This candle validated what? The change in state of delivery because it closed above the open of this candle. Rallied, and you can see price finding support here. Boom. You take it straight. So now you can look at something here. We are not using this candle. We're using this concrete and candle because you can remember I said we want the order block to form the lowest low, or the swing that has the order block form the lowest. So we can say this swing form the lowest low. But here it's not from the lowest low. Neither is this. So assuming this candle here took out this low, let's say this low here was taken. Okay, this is the lowest low. So let's say now this is a swing. All right. So assuming this candle here wick through this low, we will not be using this again because it has invalidated this bullish order block. Instead, what we use would be this candle here. Well, although we can see that the open is just at the same level, similar to themselves. So let's move forward. Now, I would like you to identify the down close candle. As you can see here, price is consolidating. I'll give you time. All right. So here's a down close candle. You can see price did what? Closed above it. So it confirmed what the change instead of delivery. Price was delivered in the downside. And then we're expecting as soon as price closed above the down close candle, that is the most recent form down close candle, it has changed its state of delivery. So if you put your stop here, you would have been taken out. So it doesn't work all the time. I would like us to have that information. So moving forward, we can see that we have what? Consequently down close candle here again. So I'll outline it. This is the open. And what do we see? We see price closing above the open of this consecutively down close candles. So as soon as price return, we want to be buying. But we can see again, price took out this low because this is where we're putting our stops, if you can remember. So it works like this. So what we want to do is we want to avoid consolidation. Market is consolidating. Now we have another example here again. This is a down close candle. You can see how it took out this low. And then this kind of confirmed the change state of delivery, close above the open. So as soon as price found support, it rallied. Now we can see multiple examples here. This is another candle. If I draw it out, see that this candle validated the change state of delivery. As soon as it closed, immediately we see another candle finding support, rallied. And then here again, we can see it failed. But we can see another example here. It was validated by this candle. So as soon as price found support, it did what? It rallied. Okay, now I want you to take note of something. Those that have high probability are the ones that do not waste time. Okay, let's look at this. You can see here, price delayed. As soon as price formed this down close candle, you can see the time it took to close above the open. See the time is spent. But if you look at this candle here, there was not much time spent. But look at this here. It formed a V shape. Now, when we see a change instead of delivery, usually it forms a V shape. In a higher time frame, it will form a week. So let's see if we can see this at the daily time frame or 4-hour time frame. Let's see, form a week. Don't know. Okay, let's go to the 4-hour time frame. So probably it's not visible. Let me make it visible. Up, 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 up. Visible. Okay. For those of us that don't know how to use this feature, you can make this visible in the 4-hour time frame, whatever time frame you wish. You just come here, go to settings, and then so this is the 1 hour, this is the minutes time frame. So you can make it visible in the 5 minutes. So it just depends on where you want to be able to see it. So before I could only see it in the 1 hour. So now if I expand this, I can see, you can just look at this number here. I wanted to use my hand to point to the number, forgetting that you can't see my hand. All right, so if you increase it, you will see that you're able to see it from 1 hour to 24 hours. Okay, so let's go to the 4-hour time frame. Oh, good. I love this. So you can see it's forming a week. Usually when price wants to reverse, it does not spend too much time. It spends little time. So you can see it keep forming weeks. As price is filling its fairly gap, it formed a week. As price is, although this is an exception, you can see that. You can see how long it took. Anyway, this will be a week in a higher time frame. Let's go to daily. You can see. Good. It's forming it. But if you see something like this, let's see, let me look for a good example. Something like this. When you now see price, you see how long it took just to, you see, you can see how it did not go higher because it's taking too much time. All right, so let's just go back to our example quickly. Now, if you look at the ones that were of high probability, they did not take time. As soon as it took this low, as soon as it ran lower, it ran higher. There was a close above, ran lower, ran higher, quickly. But here you can see how it wasted time. Even here again, you can see it wasted time. Now, it doesn't happen all the time. Sometimes it could waste time and still work. I hope we get that. So you can see the amount of time it took. Boom. All right. So now the strategy I'm going to teach you guys is just very similar to the entry model. All you want to do, I'm sure most of you already have an idea. What you want to do is to identify a change state of delivery. So you can see this candle here confirmed the change state of delivery. This candle because it closed above this candles open. What you want to do is you want to go down to a smaller time frame as price is finding support. So I don't think we should use this example because it's happening outside the Q zone. So let's look for a very good example to use. Okay, I'll use this example. There's another one here. We can see this consecutively down close candles. All right. So here you can see price finding support. This candle validated the change state of delivery as it closes above the candles open. So I'm just using a buy example. It also applies for sales. If I see a sell example, I'll outline. But let's just look at this. So now from the 1 hour time frame, we can go straight down to the 5 minute or the 3 minute time frame. And I'm going to explain how I choose the time frame I best use. Okay. So now we can see this is a 5 minute time frame. All right. This is the London Q zone. This is our change state of delivery. That is our bullish order block from the 1 hour time frame. Now we can see a change state of delivery here in the 5 minute time frame. So this is consecutively down close candle. So if you draw out from the open, you can see this candle confirmed the change state of delivery. And we're expecting that as price comes down, we'll be buying because this is our entry and our stop here. You can see how price found support and then rallied. So now, if we go to the 3 minute time frame, what do we see? We can see that the consecutive down close candle actually starts from here. If I put my entry here. Now, if I should measure my risk reward, we would see that the 5 minute time frame gives a better risk reward than the 3 minute time frame because my stop is here. My entry, remember, this is our 5 minutes entry. Let me just change the color to blue. The blue represents a 5 minutes entry. Now we'll be getting what? 3R from this trade. But if I should use the 3 minutes time frame, we're getting 2.7. Okay, it's not that much of a difference, but it just helps give you clarity. You just know what to use. You are not thinking, should I use this? Should I use that? You just know what to use. It's more objective. This gives you a better RR, so you use it. All right. So I'll go back again so that we'll see it. So here is our 5 minutes entry, and here's our 3 minute entry. So you want to choose the one that gives a better RR. Now, mind you, I will say, be careful of using the 1 minute time frame. I myself personally don't use the 1 minute time frame. But let's go to the 1 minute time frame and see what it gives. I personally don't use the 1 minute because the 1 minute can be very, very deceiving. You could enter and get wicked out multiple times. Okay. So you can see, okay, 1 minute will be entering here and then going out. But if you look closely before taking this trade, now because we're all looking at this in hindsight, if you're taking this trade first hand, you'd have taken a loss here because all we are waiting for is price to reach what? This level here. And you can see this did not touch, here did not touch. So here it touched. You see finding support, and then it created what? A down close candle. And we can see that this candle here closed above this candle. So if you wouldn't mind, you would want to draw this out. And then you can see our price is finding support, but did not rally higher, took out this low. Now, why is this important? You need to backtest this. Don't just take this and start applying it in your trades. Backtesting, what does it do? It gives you confidence and it helps you refine it better. Now, when refining for yourself, you could say you wouldn't want to see price rally this far before coming to your entry. Now, that increases probability because usually, if you see multiple examples, I personally have back tested it myself. And when I see something like this, I avoid it. I have A setup, B setup, C setup. I avoid C setups. I would classify this as a seed setup. And you can see our price closed up where we ended. It just retraced. You can see our price did not get to the open. It started rallying, even took out this high. And then, so if price is coming back down, of course, I wouldn't want to be entering this trade. Now, this is just my opinion. There are times that price will find support happening like this and rally. It happens. But the idea is to pick high probability setups. So again, our advice that you back test this. This is just very simple. All you're waiting for is change of state of delivery. You know where to enter and you know where to put your stop. So to reiterate, high probability setups, what you want to see is speed. And what do I mean by speed? It should form a V shape, just very simple. For a bullish and then for a bearish V shape. So you can see here, there was a change set of delivery, price rallied lower fast, took out this low, and then changed immediately. There was a closure above this bearish candles open. The open price, you can see this candle here closed above. So as price return, price rally. So speed as price takes the low up, as price closes above, this candle is open. So speed, we want to see speed. The next, it should be clear and easy to read. It shouldn't be something like maybe price goes down and it's looking like you are trying to figure out what's happening. No, it should be clear and easy to read. And then last, you want to keep it simple. Very simple. Clear rules, easy rules, keep it simple. All right. So if you enjoyed this video, please give it a thumbs up and do subscribe if you haven't subscribed yet. See you guys next week.